Welcome to Trading Nation. I'm Eric Chemi, joined now by Sugata Ray of the University of Florida's Warrington School of Business. Sugata, you co-wrote a paper with a couple other authors comparing hedge fund performance to the cars that these hedge fund managers drive. What did you find? Tell us about it.
Absolutely. Be my pleasure. So basically, we looked at the cars that these fund managers drive, and we looked to see if they had any predictive power over hedge fund returns. It turns out that they do. Basically, managers who drive sports cars tend to take a lot more risk in their funds. And the way to look at it is the cars that people drive just provide another data point into who they are. In this case, they reveal something about themselves, and we couch it in our paper in terms of sensation seeking. And that is reflected in their funds, taking more risk.
And so it seems like also from your paper, if you have a high-risk car, then you've got a high-risk fund, but it seems like the performance of that fund is worse relative to that risk. Is that right? Are you basically saying if some guy who runs a hedge fund has a kick-ass awesome car, I probably don't want to invest in that fund because he's going to do worse given the amount of risk he takes? Is that right?
That's exactly right, Eric. The Sharpe ratio, which is a measure of performance per unit of risk that the funds take, is lower, significantly lower, for funds that are managed by sports car driving managers. And not just that, it gets worse. Separately from the financial risk, these managers also experience higher operational risk in the form of form ADV violations. So these are bad things that happen to the fund, like getting sued and such. And they experience higher fund mortality, so they're more likely to stop existing.
So I got to say, I worked at a hedge fund before and on a prop trading desk. I saw a lot of this behavior. I saw guys with very fancy cars. The hedge fund I worked at doesn't exist anymore, so that's another data point for you to consider. But I'm just curious, how did you figure out the cars of these hedge fund managers? How many people are you stalking or tracking? Where is this information available? Are you talking thousands of fund managers? What's going on here?
Yeah, there's a beautiful data set called vin.place, and you can go there. As you can imagine, this website, vin.place, is getting hammered today. But you can type in a person's name, and these guys just track all new car purchases in the U.S. In the period that we got data from, I think they had it from 2007 to 2012. And you get the new car that was purchased. You get the VIN number of the car. And then with the VIN number, we went to AutoCheck, and they very kindly provided us access to look up the VIN. So we got a lot of additional information on the cars, when the car was bought exactly, because we're going to need that information to do our analysis, some of the driving history, exact makes on the exact details on not just the make and model, but also the trim, so we can pin down some of the performance characteristics. But yeah, short answer, vin.place has the car purchase data.
So that's a lot of stalking, which I think can be a whole other discussion, another conversation for later. But then I want to know, if I'm investing in hedge funds, what's the car that I want my hedge fund manager to drive? Is it a minivan? Is it some very safe Volvo sedan? What's the ideal car that I should be looking for in my manager?
Both of those are excellent bets. So the minivan is kind of like the anti-sports car in our paper. So we have pro-sensation variables, which are sports car is a pro-sensation variable, high horsepower, high torque are pro-sensation variables, and we have anti-sensation variables. So driving a minivan is an anti-sensation flag. Cars with high safety ratings, a Volvo, for example, is going to be anti-sensation flag, and anti-sensation flags signal the exact opposite of sensation flags. So these are managers who are going to be taking less risk in their funds. Their funds are less likely to blow up. Their funds are less likely to experience fund termination. And at the same time, their funds do no worse, so their Sharpe ratios are higher.
Well, I think this is extremely fascinating, Professor Sugata Ray of University of Florida's Warrington College of Business. In the future, if you're looking for a hedge fund manager, look at their performance, figure out what car they're driving too. Thanks, everyone, for watching us here on Trading Nation.
Thanks for having me.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.